It looks like a once-in-a-generation change is happening in China under its new leadership. So how can you and I profit from it? Last week I talked about the big changes that new Chinese leader Li Keqiang is bringing to China. Less state control of prices and interest rates, more controls on the shadow banking sector. Each of these will have a big impact on certain kinds of companies and therefore on their attractiveness to investors. But there's a third prong to the new leader's mission that could have an even bigger impact. He intends to stamp out the corruption that's become endemic across Chinese society. For decades now, the ultimate sinecure has been the post of Chinese official in charge of a key part of the economy. If you want that juicy government contract, just give me the keys to that S-Class Mercedes. If you want your maintenance contract to be renewed, a holiday in Europe for myself and my family would be much appreciated. The Chinese people have had enough of this, and Beijing has caught the zeitgeist. There will be change. As with all political manipulation, the impact is not always obvious. You need to think about the kind of companies who'd benefit from the old corrupt regime. Makers of high-end consumer goods, for example, the sort of expensive spirits that would make a nice bung. Event organisers with fewer parties to cater for. Retailers of Swiss watches and French wine. Samsonite has already warned that luggage sales are slowing down. So the companies to avoid would seem to be those who provide the goods and services that have been used to oil the wheels these last few decades. The beneficiaries of these changes should be companies that are catering to the still growing Chinese middle class. The Chinese stock market is not available to foreign investors, and it's been heading south for over a year now. We can get access through Hong Kong-based red chips and H shares, but these are usually shares in government-run companies most likely to be hit by the anti-corruption drive. So if you want to gain exposure to China in this new era, you either need to look for Western companies with exposure to that growing middle class, such as Unilever with their Lipton's tea and Magnum ice cream brands, or Intercontinental Hotels. They're listed in London, but they're the biggest international hotel chain in China, catering to the increasing need for business and leisure travel among that emerging middle class. But if you're looking for a higher risk-return profile, maybe you need to look at the native Chinese brands that look like they're in for the long haul. Nongfu spring water and Wahaha smoothies are bigger than Coca-Cola in China. You've probably heard of Lenovo because they bought IBM's personal computer business back in 2005. They're about to buy Motorola's handset business from Google. Never mind Nike and Adidas, the sportswear to be seen in Beijing is called li-ning. Forget Beck's or Coors Light, the biggest beer brand is Snowflake. Mind you, that is 49% owned by SAB Miller, whose shares you can buy in London. Some of the biggest fortunes in investing are made at times of great change and upheaval, times when most people feel uncomfortable and uncertain. We might just be at such a crossroads in China. There's a heady mix of opportunity and risk out east. So, as ever, be careful out there. In many respects, China is to blame for the economic meltdown in 2008. By swamping the Western world with their low-priced exports,